Hello, I'm Brian Akers from Akers Financial Group. I'm the president and founder of Akers Financial Group, a financial advisor, a certified financial planner practitioner, and a person that's very happy to be here with you. We're going over our mid-year market update. We have for you today Mark DiOrio to go over the markets and what's been going on with everything this year. We also have myself going over the Akers Financial Group select portfolios, our core portfolios that we manage through Brookstone Capital Management. Also, I got to talk about OBBBA, the One Big Beautiful Bill Act, which began on July 4th, was signed into law. This tax bill makes permanent the Tax Cut and Job Act of 2017. So what happens there is the fact that our lower tax rates we've been using for the last couple of years is going to stay in effect. And this time it's permanent in that there'll have to be another vote in Congress down the road to be able to make changes. There's also some information about Social Security. Social Security really did not get a deduction, but what happened is they gave those over 65 a personal exemption amount of 6,000 per person, subject to income limitations. There's many more things done about that bill. Paul Franco and I did a radio show on our show Winning in Retirement, and we have that recorded on our website at akersfinancialgroup.com under our radio podcast tab. Right there, you can actually go in and listen to that show anytime you like, or through any podcast site that you'd like to listen to by typing in Winning in Retirement and look for the One Big Beautiful Bill and You, a radio show that Paul Franco and I just did. This fall, we're going to have some classes on this tax bill and how it affects people when it comes to things like the Social Security over 65 exemption, the tax brackets, and the bottom line of what we're going to recommend, which is taking advantage of good tax rates to convert things to Roth, pay tax now and never again, make planning decisions that can make your money last a lifetime for you and build a legacy for your family. All this can come together through proper tax and financial planning. That we're going to have some classes this fall, but the big thing we're going to have this fall will be our Winning in Retirement Training Day. This year, we'll have a special forum, an Akers Financial Forum, we're going to take two classrooms and make a very large classroom where I'm going to host it. Yeah, for the whole day, we're going to host that one section. In that one section, we're going to have one major topic after another every 25 minutes. And we're going to bring together to you everything that we work with our clients at Akers Financial Group, how it's working, what's going on, updates. We're going to talk about taxes, Medicare, Social Security, protected investments, core and satellite investing, market updates from Mark DiOrio, lawyers. What'll happen is I'll be up on stage and I'll interview a little bit of everybody talking about what's going on, introduce you to every advisor that we have at Akers Financial Group. We now have 6 advisors as all part of advisory teams to serve you and all of our clients the very best way possible. We do thank you very much for tuning in today and ready to listen to everything that we have. We have a lot of information, a lot to do with. What we want to do is start our day by going over with Mark DiOrio what's going on with the market. We began this year, got 6 months into the year. And so what Mark DiOrio is going to do is go through his information that he has put together. Mark DiOrio is the Chief Investment Officer of Brookstone Capital Management, and we welcome him to our event. Hey, Mark DiOrio, thank you for joining us on our market update for the middle of 2025. Thank you for your time today to go over the state of the markets. Mark DiOrio, how's your year gone so far?
It's been a great year. It's been a little topsy-turvy in the market for a little bit, but we had a great ended up being a great second quarter.
Oh, I guess it had to be right after the start of the year, into the first quarter, into the April, got a little ugly on the downside. So I look forward to seeing the numbers and hearing you talk about the markets, what's going on now. Thank you again for speaking with our clients about the markets. Mark DiOrio is from Brookstone Capital Management, the third-party money manager we use out of Chicago, Illinois. And as they manage the money, Mark DiOrio leads all of that as portfolio manager. What's your other job titles there at Brookstone Capital
Chief
Management?
Investment Officer, so I oversee the
Nice.
entire investment platform
Yeah.
as well.
And then you're a CFA. And so the CFA next to Mark DiOrio doesn't stand for Chick-fil-A. It's Chief Chartered Financial Analyst, which is a great designation for every investment person out there. All right, so Mark DiOrio, let me give the microphone to you and give us a little rundown of what's going on this year so far.
Well, great. Yeah, let me just jump into the slides and walk through those. And so, as I was mentioning, the second quarter was pretty exciting in terms of the way we started it with news driven and Liberation Day, as it was called. And the market dropped precipitously. You can see from the chart on the left-hand side, dropped 12% in 4 days. It was very quick. Then we started to have a rebound, but news headlines continued, and the market just kind of absorbed that and kept rolling on to the point where we actually eclipsed an all-time high by the end of the second quarter. So that was just barely above where we started the year. But nevertheless, it was that recovery, despite all these news headlines, that I think was showed a lot of resiliency for the market. So I think that took a lot of professionals and also other retail investors by surprise at how strong the rally back was. And just giving an indication of how strong the rally back was, it was one of the quickest 25% recoveries that we've seen in the NASDAQ. And the NASDAQ is the tech heavy stock. So there's been a lot of mega cap leadership on this rebound. And on the flip side, a lot of the mega cap tech stocks actually lagged to start the year and was driving down and pulling down the overall market year to date until we basically had that ultimate sell off and then the bottom and then the recovery started. And so you can see on this chart that there's only been a few times when we've had this robust recovery. It was the 2020 pandemic, going back to the 2008 financial crisis, and then circa the kind of the tech bottom in there after we had the tech bubble in 1999, and then a series of fits and starts in between 2000 and 2003, essentially, as the market tried to get out of that bear market. And the reason for a lot of the volatility early on in the quarter was that confusion on policy and tariffs, and at the time, Doge, what kind of government cuts could be in store. So there's a lack of clarity of what that meant. In this chart here, and you just see on the right-hand side, kind of in the second and third clip, these big spikes, and what they represent is policy uncertainty. So this goes back to the 50s, and that's as big a policy uncertainty that we see in the market. So that took the market by surprise, and really the reason I think for a lot of the hesitancy and a lot of the volatility that we saw in the front part of the quarter. And some of that had to do with, well, what is the implication with tariffs? Since we haven't really used that as a policy so much over the years, or an economic policy over the years, one of the concerns is that it would spark inflation. And so on the left-hand side is really an expectation. Consumers' expectation of inflation really jumped higher very quickly. And so it's kind of put this overhang, or kind of a boogeyman, if you will, of that inflation's going to come back and come roaring back. However, on the right chart, the hard data really hasn't supported that. In other words, inflation has been well under control, well under 3%. And so we've been in that 2.5% range, plus or minus, for some time now. So inflation has actually been pretty tame. And when we look at data like something called the Baltic Dry Index, trade has not stopped. Trade has continued just to plow forward. So it's really interesting of what's been happening. And there's really a dichotomy between what we call the soft data, which would be expectations. And so expectations are for higher inflation, and the hard data, is showing really a muted inflation outlook, which is ultimately positive for financial markets. In fact, with these lower readings on inflation, there is an expectation that the Federal Reserve would reduce interest rates. They have been hesitant to do that this year. And a big part of that is because the uncertainty around tariffs and the potential for inflation to come back. So what they do is try to keep rates a little bit higher when there's the fear of inflation, just to make sure that things don't get out of hand. And then if inflation is starting to come down, they can lower those interest rates. And so right now on the left-hand side, we're between 4.25% and 4.5%. We're in that midpoint range of where the Fed funds or short-term money is at. As you go out, and this takes it by date, the market expects by December 31st that we'll be closer to about 375. So a couple of reductions, a couple of quarter point reductions in interest rates. And then it takes it out all the way a year later to June 30th, 2026, and then looking at 3.25%. So the market absolutely expects that the Federal Reserve is going to reduce interest rates here. So we'll see how that plays out, but that is the current market expectation. And so one of the differences in the most recent couple of years has been that interest rates have risen. So bond yields have risen, and it's kept mortgage rates a little bit higher. And that can cause pause, and you can see challenges. In 2022, we had a bear market, kind of a tough time for equity markets. For a long time, rates have been very low. So if you take it from about 2010 to 2021, thereabouts, rates have been extremely low, about the same as the dividend yield on stocks, the overall stock market, in that 2% range. And so now we've had a gap, which we saw from about 2000, 2007 range, where you get a little bit more yield on those bonds. But if that's coming down, that's ultimately going to be positive for equity. So that'd be very supportive if that happens. If we stay here with this gap, then it would start to call into question valuations and things like that. And that's why the interest rate environment is so important as we look forward. The chart on the left shows expected earnings. So earnings drive the stock market, and then the level of interest rates tells you where the market should value an increasing earnings stream. And so this helps put a fair valuation on the market. So right where you see in the middle there, we're at about 6,200 kind of at the end of the quarter. Where would we be if earnings decline? So you move left. And then where would we be if earnings increase? You move right. And then you go up if the valuation goes lower, which would be if interest rates rise. And if interest rates lower, you could actually see maybe going down that list a higher valuation. But I think the current valuation is probably where we'd be, and it'd be so you'd go left and right from that kind of that yellow box there. If earnings decline, the market would probably follow suit and decline a little bit. If earnings surprise to the upside, markets would be supportive and continue higher. And so as we get into the back half of 2025, what's important is the market's not just going to look at 2025's earnings. It's going to start to look into 2026, 2027, and start to anticipate. And so 2026 earnings look like they're going to be up double digits. I don't know if that's going to stay or not, but if that's the case, the market will start to value off a higher level of earnings. So we pay close attention to this, and this is kind of our gauge of where the market's trading and sets our expectations. So going forward, we're really looking at interest rate cuts. Are they going to happen or not? There is a big expectation that they'll start in this third quarter by September and then continue into December, which can ultimately be supportive of stocks. Now, the other corollary is, why are they reducing them? They're reducing them because inflation is tame and they want to get interest rates back into alignment so they don't keep policy too tight, as it's called. In other words, you see that maybe in the housing market where higher rates make it a little bit more challenging, or affordability is very challenging, so they'd want to bring rates lower. However, on the other hand, if it's for a crisis event, then there's a different set of circumstances. But that's not our base case. Our base case is that inflation is somewhat tame and they're just trying to lower interest rates to accommodate the economy and not keep rates too tight for too long. The second point is, does inflation kind of pop out and is actually stronger than the data is showing, and that would cause a pause in any interest rate reductions. And then, of course, the uncertainty around tariffs. So we would say that the tariff policy it's not necessarily going to change. It is the policy. So for us, we're not policymakers. We're trying to make good decisions in the face of uncertainty, which really just means we're investment professionals, we're investment managers. We need to make decisions regardless of what the policy is. So we take this into account, and we just put a base case as this is part of the policy and the policy environment. So we have to keep that in mind, that that's going to be part of the investing landscape. I did want to point out, though, that mega caps, as I started kind of referring to them, the mega cap tech stocks, these ultra large companies that are in the trillions of dollars in market size now, pretty phenomenal in terms of the size of the companies. The top 10 stocks currently represent about 38% of the entire S&P 500 index, meaning those 10 stocks are heavily weighted in the index. And that's the most, this goes back to about 1973, 74. That's the most concentration in the top 10 stocks that we've ever seen in that time period. So we are in rarefied air. That's how important these stocks are to the overall market. But I would say there's 490 stocks that may not have been appreciated by the market and haven't driven the market. So there is opportunity beyond these top 10 stocks. But that's a real concentration concern that we see. Not that the companies are bad, it's just that they're getting so large that we have to take that into account when we make investment decisions and build portfolios, that we don't want to be overweighted or overly concentrated. And that diversification is still important, even though we're going through a phase where these mega cap stocks have really been the darlings. And to put that kind of a nice point on that, the chart, the blue line is the S&P 500. The multicolored line below that is if you invested in the largest stock at the time and then held that until it lost the largest stock position and went with the next largest stock. Now, on the top left there, you can see some of these great names that have been there before: Microsoft, Apple, and so forth, and GE over time, and ExxonMobil. Well, you can see that the solid blue line, the S&P 500, is handily eclipsed, moving from the largest stock to the largest stock. So even though that's the most popular name, or one of the most popular names in the index, and it's talked about a lot, the returns seem to start to subside once it gets to that position, and why diversification is so important. So we wouldn't just concentrate on those large cap stocks. We'd look beyond that. And I think this is a nice illustration of why we do that and create that diversified portfolio. So it's just a reminder that although there's top stocks and they get a lot of headlines, there's a lot more value underneath those top stocks. And really the returns for investors and investors would benefit from diversification overall. So that's what I had, Brian, and I'll jump you back in if you'd like to come back in.
Thanks for letting me come back in.
Sure.
Can I ask questions about your fancy chart?
Absolutely.
All right. So basically, you were saying that when it became the top stock, that's when you changed it. Is that
Correct.
true?
Yep.
So the growth to get to be number one is not included. That's why it underperforms the market, right?
Correct.
All
Correct.
right, that makes sense. And then I love the slide 8, the S&P movement of the lower earnings, and I love that slide.
Oh, great. Yeah.
That really demonstrated very well to me, and I think to everyone, how the market can move based on earnings. Now, when I see we're at 22, I say, wow, that's way overvalued. Is that me being too conservative and not really cool with the times? What's going on there?
Well, I know you're a market historian, so I know where you're going with this, which is the historical valuation is
Yeah.
16 times
Okay.
earnings. However, what I would say is that the changes in the economy over time
Mhm.
would actually suggest maybe the average is higher. And the reason for that is because we have a lot more tech stocks now,
Sure.
which can trade at higher valuations than industrial companies that are more capital intensive.
Yep.
And so you'd have a little bit higher. And I might say 20 to 22 is reasonable. When you get to a declining, if
Yeah.
earnings start to decline, then maybe you get to that lower. And it can go lower than 20 or go to 18. And you may see 16 again at some time if you get into a bad recession or
Yeah.
something like
It's like
that.
a sort of a bottom type thing then. Okay.
Yeah,
Um,
correct.
Other concerns, like, well, they've been changing rules a lot. They have the OBA law. Does that affect stock market? I like to say no, but what's your general thoughts as a market person?
Well, I think the markets deal with any adjustment or any new law, any new policy change as not as maybe an immediate reaction, and then the market forgets about it and
Yeah.
starts to move again on what our earnings going to look like.
It gets
And
priced
so
in very quickly, right?
it does get priced in and very quickly. So there's theory, efficient market hypothesis, and so forth. So the market reacts very quickly to these changes.
All right, so let me throw the next one in. That is all the wars and rumors of wars, the concept that they could basically put more what do you call it, restrictions on Russia. Um, what's your thoughts on that? With market volatility, I think is going to be the answer, but what's your thoughts on the idea of all the wars going on?
Yeah, I think geopolitical events have a relatively short life. So even when if you go back to when Russia invaded Ukraine,
Sure.
usually it resolves itself within 2 months as far as the market is concerned. In other
Right.
words, there's a reaction and then the counter reaction, if you will, and then the market kind of stabilizes from there, and then it's on to the next issue. So it's not that it's a big deal or not a big deal. It is a big deal geopolitically, but for the market's perspective, it often what we see is it often moves beyond those crisis events, and it's pretty consistent in terms of the time frame, where you have maybe 1 month that's bad, and then the next month it kind of recovers and stabilizes, even when there's not a resolution. And
Well,
that's important. I think sometimes people think we have to wait for a resolution. Well, the
right.
market doesn't wait for a resolution.
Well, the sanctions would be an escalation. That'd be a new valuation that could cause volatility.
Well, I think anytime something new comes out, it'll cause some level of volatility, and then the market will say, "Well, how big is this from an economic impact?" And they may say somewhat minor or much smaller than you think.
Okay. The U.S. dollar. What's your concerns about the U.S. dollar, and how does that affect us? Is that inflationary? What's going on there?
So the dollar has been very strong for quite some time. So our purchase power parity, or a measure of purchasing power parity, has shown that the dollar has been overvalued for a while and
Right.
kind of significantly so relative to other currencies. And for all the right reasons, the US is the dominant economy, dominant consumer economy, and so forth. And now that is reversing. And I think that makes sense. It's not a doom and gloom scenario on the dollar. The dollar is going to be around as the dollar is going to be
Yeah.
majorly used. It's the number one currency pair in the world by far. It's 80% of volume in the Forex market has the US dollar on one side of the trade. So I think that's going to remain, but the relative value can decline. And the implication would be, and is one of the reasons why international stocks all of a sudden, after underperforming for 15 years, outside of very few scenarios, actually had a pretty good first 6 months. And that might actually stabilize and become a trend where international, maybe as a component of the portfolio, actually starts to participate and provide some diversification benefits.
Yeah. Yeah, there's so much going on that can cause volatility. I hear lots of positive from your report at this time. I know we always love hearing from you and hearing what's going on in the markets, and we do enjoy working with you over the many years. Thanks again, Mark DiOrio, for your time today, and we'll talk to you later in the year. Take
Great.
care.
Sounds good. Thanks, Brian.
Thank you. Well, we thank Mark DiOrio for for our opportunity to listen to the market update that he gave us. We really do appreciate it. This time, what we're going to be doing is going over the Akers Financial Group select models. So I have here our portfolio numbers for 6/30/2025. What you'll see is that we have four portfolios. These portfolios are income, moderate aggressive, and diversifier. As you go over these today, we're showing you the actual secret sauce, the allocation that we are currently. I believe these core portfolios are part of the design of our active investment management that is good for many of our clients, not for everybody, but for many of them. And what we do is at Akers Financial Group is we have an investment committee that puts together these portfolios, and we trade twice a year or a few times, depending on what's going on in the markets. Trying not to trade all the time, but really try to watch the trends, the long-term trends of the market, to manage a portfolio with less risk than the S&P 500, and trying our best to build a portfolio that's actively managed with some downside protection through the diversification that we do. It's always been my dream to have portfolios designed around the idea that we have the best of the best in the categories, and we can bring them together in our portfolio design. We made some trades in the middle of May, and those trades allowed us to diversify more at a great opportunity before the market really fully recovered from the March, April dips after the tariffs first came out. And so we built the portfolio out in a little different way, took a little gold profit at the moment and built from there. Now, on the portfolios, we have the income portfolio, truly designed of those that need income. And we have a design also called moderate, which is one of our core portfolios. And the difference between moderate and moderate aggressive is a little more technology in the moderate aggressive. And then there's the diversifier portfolio, which does not have US stocks at all. This diversifies away from the US market in a way where we have commodities, gold, silver. We also have the availability of some real estate and international investing. Year to date, our diversifier is our number one performer at 12.5% after our fee. The fee that we use in this portfolio is the highest fee we charge at Akers, which is 1.5% on accounts lower than $250,000. Our portfolios have breakpoints at $500,000, 1 and 2 million, and above. Our portfolios, the income fund is up 4.9% this year. Our moderate's up 8.4, and our moderate aggressive up 8.9% year to date. The 8.4 for moderate, 8.9 is both better than the S&P 500 by about 0.5% and 1% for moderate aggressive, and higher than the S&P 60/40 portfolio, which is a combination of the S&P market 60% and bond market 40. We're about 3% ahead of that year to date. Last year was a good year, and so was the last 3 years. We've had 2 down years since we started back in 2017. Our best performer, the moderate aggressive net of fees, is 8.93% over that time period. The portfolio, these sheets are available through our offices and tell you how we invest, and also can give a history of year by year, month by month of our portfolios. On October the 10th, we'll have our training day. On our training day, what we're going to do is cover portfolios just like this. Our AFG portfolio will be covered and reviewed with detail, going over the investments that we have and how we invest the portfolio. So that's our portfolio. When you look at the AFG Select, that's one of our core portfolios that we use. We also use Brookstone Capital Management for our more diversified core and satellite. October 10th, we're going to go over the AFG portfolios in greater detail with the investment committee inside of our Akers forum. This will be a large classroom where we'll go over how we design portfolios, and we'll talk about the AFG Select portfolio and how it can work for you as we diversify your money to make this money last a lifetime and grow to beat inflation over time. AFG Select portfolios are managed through Brookstone Capital Management, held at Charles Schwab, and they're fee-based in that there's a fee that comes out of them that pays the managers and pays the advisory rep that is working with you. All right, there's a lot going on today, and we thank you very much for listening to our mid-year market report. We have a lot of information to go over here at the end. Winning in Retirement is our radio show. Our radio show is on Saturday morning on 105.7 The Fan at 11 a.m. Over the years, we've added at 10 a.m. on Saturday, 6:80 a.m., and 9 a.m. on Sunday, 6:80 a.m. That's the live shows that come across the radio. We also have them on our website, akersfinancial.com, and you hit the radio podcast tab, and right there you can actually listen to the shows, or you can go to any podcast site, typing in Winning in Retirement, and what you'll get is the information to be able to how do we say it, listen to the show. What's nice about the podcast, you can speed it up and listen to us at a faster speed if you like. Akers Financial Group, we've been growing a lot this year. We've added a couple advisors. One of the advisors at Akers Financial Group is Noah Akers, is a full licensed advisor working with clients currently. He leads Brian Akers' team, and he's been seeing clients as an advisor. And then we've added Nick Malidi. Nick Malidi is 15 years as a financial advisor, and we brought him in here in June to begin working with our clients. As we build out our team of advisors, this allows us to serve people better and more efficiently, and to be able to have advisors ready when you're ready to talk. The opportunity to work with you is always a pleasure. It's been a pleasure of a lifetime for me. Akers Financial Group is a company designed to take financial planning and apply it to you in your life, where we can help you where you are and help you get to where you want to be. Akersfinancial.com is our website where all the information is. We have information on Facebook. We have a lot of things going on with our calendar. You can check out our events calendar. Mainly check out our weekly email that Kim Haight puts together. Kim Haight, our director of marketing, is doing a lot of things for our firm and for our clients this year. Pay attention to all of those and make sure you mark October the 10th as your day to go to Water's Edge to see all of us at Akers Financial Group, meet our new people, hear from each and every advisor as we speak and go over the markets, the tax law, Social Security, income, investments, all this put together in a great way. And of course, it's going to be food and fun. Music brought to you by one of our newest employees. He's been around about a year. Andy Griglock will bring him and his wife to sing for us during our food and cocktail hour. We do thank you very much for listening to our mid-year market update. I'm Brian Akers from Akers Financial Group, and we thank you very much for listening. Any questions or comments, please contact us. We love to meet with you and go over what's going on. Thank you.